Today we are going to cover bonds and bond valuation is Chapter 5 in your text. Bonds are long-term contracts where the borrower agrees to make payments of interest and principal on specific dates to the holders of the bond. So bonds work just like debt. They are debt. They work just like a typical loan you and I would have. We're making interest and principal payments on specific dates to our debt holders, and there is a maturity date. So at some point, these will be paid off. Treasury bonds are issued by the federal government and have relatively no default risk. Corporate bonds are issued by corporations. There is some chance of default, and the default levels vary by company. So we're going to talk about bond ratings in a little bit. Municipal bonds, also known as munis, are issued by local and state governments. They have fairly low default risk. And the interesting thing about municipal bonds is that the interest earned on these municipal bonds are free from federal and state taxes. Foreign bonds are issued by foreign governments or foreign companies. When we're determining the intrinsic value of a stock, one of the primary ingredients is the cost of debt. And so we're going to cover that in this chapter. Some things that you need to know about bonds before we get started. Bonds have a par value. This is also known as the face value. It's the value that's going to be paid at maturity. We generally assume that it's $1,000. Bonds also have a stated coupon rate. This is a stated interest rate. To get the dollar value, you multiply the coupon rate by the par value and divide by the number of periods per year to get the dollars of interest paid each period. Some pay nothing, and these are referred to as zero coupon bonds. The maturity of the bond is the number of years until the bond must be repaid. It declines each year until after the issue year. The issue date is the date when the bond was issued. Some bonds have provisions. A call provision gives the issuing corporation the right to call the bonds for redemption. The issuer can refund if rates decline. It generally says that the company must pay bond holders an amount greater than the par value if they are called, and this is referred to as a call premium. Deferred calls are when bonds cannot be called until several years after they are issued. And a declining call premium is the fee for calling a bond, and it declines each year after the issue. Convertible bonds have the option to convert bonds into shares of stock. Warrants are options that permit the bond holder to buy stock at a fixed price. So when we're valuing bonds, it's going to look like this. So at time period 0 is the issue date. Each period, the bond holders are going to receive an interest payment. This interest payment is based upon the coupon rate. The coupon rate is stated, and upon maturity, the bond holders will receive the face value of the bond. The required rate of return is not the same as the coupon interest rate. The required rate of return is the discount rate that we use to calculate the present value of the bond's cash flows. Because remember, the value of any asset is the present value of the cash flows the asset is expected to produce. N is the number of years before the bond matures. The interest, INT here, is also the same as the payment. It's the coupon rate times the par value. And M is the par value, also known as the face value, and we usually assume that that's $1,000. So you can think of bonds as interest-only loans. The corporation, you purchase a bond from a corporation or from the government for X amount of dollars. Each period after that, you will receive an interest payment based upon the coupon rate, which would be stated, and upon maturity, you will receive the face value of the bond. So the amount of money that you give the corporation for this bond varies dependent upon the number of years to maturity. Additionally, it depends upon the stated coupon rate and the market interest rate. So the value of the bond is equal to the present value of the interest payments each period plus the present value of the face value of the bond. So here we have an example. What is the value of a bond, a 10-year bond with a 10% coupon, if the cost of debt is 10%, if our required return is 10%? So here we already have the interest payment written in, but the interest, which you would receive every month or every year or every 6 months, however the bond's set up, is equal to the coupon rate, which is stated, 10%, times the face value. If it's not stated, we assume that it's $1,000. And we divide this by the number of periods per year. If it doesn't say that it's a semi-annual bond, then we assume that it's an annual bond, so it would be divided by 1. So that's $100. That's where this 100 comes into play. So how much would you be willing to pay for a bond that's going to return to you $100 every year in interest, and upon maturity, you will receive $1,000. To determine this, you simply take the present value of each of the payments and of the value at maturity, so the face value. Because the coupon rate is equal to our required return, we would be willing to pay $1,000 for this bond. But we can do this in our calculator. There's no need to sit down and calculate the present value of each of these payments and of the maturity value. We can use our calculator. So we use our time value of money in our calculator. N would be equal to the number of years times the number of periods per year. So here that's 10 times 1, and that's 10. IY is equal to our required return divided by the number of periods per year. So 10%. The payment is equal to the interest payment, and that's equal to the coupon times the face value divided by the number of periods per year. So here that's 10% times the $1,000 face value divided by 1 to give you 100. And the future value is equal to the face value, or the value at maturity, or the par value, however it's worded. And that's $1,000. So we are wanting to determine the present value of this bond, how much we are willing to pay for a bond that returns to us $100 every year and $1,000 upon maturity. If the current rate is 10%, if our required return is 10%. So we plug this into our calculator. The first step is to clear our time value of money, so second, and clear TVM. N is the number of periods, so that's 10. The interest rate is also 10. Payment is 100. And future value is 1,000. And we want to compute the present value. And it says that we're willing to pay $1,000 to receive a bond that's going to return to us $100 per year and $1,000 upon maturity if the required return is 10%. So the present value, So the present value is $1,000. We're willing to pay $1,000 for this bond. One thing to note is that any time that the yield is equal to the coupon rate, so anytime the required return and the coupon rate are equal, the bond will sell at par. That means that it's going to sell for the face value of the bond. So the face value and the cost of the bond will be the same. What would happen if the required return increased 3% to 13%? So it's still the same problem. At time period 0, we want to know how much we're willing to pay for this bond. We're going to receive payments every period, and then the full value, the face value, upon maturity. So this bond was a 10-year bond, annual. The interest rate is now 13%. The payment is equal to the coupon rate times the face value divided by the number of periods per year to give you 100. So you're going to receive $100 every period plus the future value or the face value, the $1,000 upon maturity. So the future value is equal to the face value of $1,000. So we can plug this into our calculator. The first step is to clear the time value of money. So we enter our number of periods, 10. The required return is 13%. The payment is 100. And the future value is 1,000. And we want to compute the present value. So notice now that this cause in the required return, this change in the required return, has caused the present value to equal something other than the face value. So anytime the required return is greater than the coupon rate, the bond will sell below par value. So the cost of the bond will be below the par value. And another way to say this is that it's trading at a discount. This is because you could earn a higher rate of return on alternative investments. So the most you would be willing to pay is $837.21. What happened if the required return decreased to 7%? So here we still have our same example, 10-year maturity bond. The only thing that has changed is the market interest rate. It is now 7%. The payment is equal to the interest, the coupon rate, times the face value, divided by the number of periods per year, and that's 100. So we're going to receive $100 every year. And upon maturity, we receive our face value of $1,000. We already know that because the required return is less than the coupon rate, the price of the bond, or the cost of the bond, is going to be greater than par, meaning that it sells at a premium. So we can put this in our calculator. First step, clear your time value of money. N is 10, the interest rate is 7, payment is 100, and the future value is 1,000. We compute the present value. So now this bond costs $1,210.70. At the time of issue, a new issue, the coupon rate is usually set at the market rate at the required return that's going to make the bond price equal the par value. So generally when a bond is sold for the first time, the market price, the price that an investor would pay for it, is equal to the par value, and that's because the company has set the coupon rate equal to the market rate that will cause this to happen. Once a bond has been traded on the open market, so it's a seasoned issue, previously traded, the price of that bond varies from par. And that depends upon how market rates have changed. So after a bond's issued, market rates are going to continue to change, and this is going to cause the price of the bond to continually adjust. The market value of a bond will always approach par as its maturity date approaches. The interest rate does change over time, the market interest rate, but the coupon rate will remain fixed for the life of the bond. When interest rates are greater than the coupon rate, the market price will fall below the par value. When market interest rates are less than the coupon rate, the market price will be above par value. An increase in interest rates will cause the price of outstanding bonds to fall, and a decrease in interest rates will cause the price of an outstanding bond to rise. So basically what I'm saying here is that every bond, regardless of its coupon rate and of the market rate, is going to approach par as the maturity date approaches. So a premium bond will fall in value as it approaches maturity, and that's because each of the interest payments have already been paid. So the amount that you're earning in excess of what you would earn elsewhere, these are being paid out. And as we approach maturity, the only payments left are the payment upon maturity, which is simply the face value plus one interest payment. So the value is going to fall. The market price of the bond is going to fall as it approaches maturity. Similarly, the market price of a discount bond is going to increase as it approaches maturity. Again, that's because each of the interest payments that are making up the value of the bond are being paid, and so they have less of an impact on the present value of the bond. At maturity, the value of the bond would equal the par value. The value of a premium bond would decrease to $1,000, and the value of a discount bond would increase to $1,000. A par value bond, one that's trading at its par value, would remain constant as long as the market rate remains constant. Yield to maturity is the rate of return earned on a bond held to maturity. It's also called the promised yield. It's usually the same as the market rate of interest. It also assumes that the bond will not default and that the bond will not be called. So we can determine the yield to maturity for a bond So here we have a 10-year 9% annual coupon bond with a $1,000 par value selling for $887. So basically we know 4 of the 5 components for time value of money, and so we know that we need to solve for the IY to get the yield to maturity. Here, N is equal to 10. We want to know the market rate of interest. That is going to be equal to the yield to maturity. And we want to know what that equals. The present value, again, remember how your calculator works. It costs you $887 to purchase this bond, so you need to make sure that you put it in as a negative. Then you would receive the interest payments every period, so these are a positive. It's a 9% coupon times the face value of $1,000 divided by 1 because it's annual, so that's 90. And the future value is the face value of $1,000. So we're wanting to solve for the interest rate or the yield to maturity. That's going to make this problem work. So here, first step, clear your time value of money. N is equal to 10. The present value is a negative $887. The payment is a positive 90. That's money that you would be putting in your pocket. And you would also receive $1,000 upon maturity, so that's also a positive number. So we're wanting to compute the interest rate, and we get 10.91%. So the yield to maturity on this bond is 10.91%. That's the rate of return that you would earn if you purchased the bond and held it until maturity, assuming that the bond is not called and does not default. $10.91%. Again, if the coupon rate is less than the required return, the bond trades at a discount. If it's equal to the required return, it trades at par. And if it's greater than the required return, the bond trades at a premium. If the required return increases, the price is going to fall. And the price is equal to the par at maturity. So let's find the yield to maturity on a 10-year, 9% annual coupon bond with a $1,000 par value if the price were $1,134.20. We already know this bond is trading at a premium. We know that because the market price is greater than the par value. So therefore, we know that the coupon rate is going to be greater than the yield to maturity, is going to be greater than the market rate of return. So here, so at time period 0, we pay $1,134.20. We're going to receive, we have a 9% coupon annual bond with a $1,000 par, so that's $90. We're going to receive $90 every period, plus $1,000 upon maturity. So N is equal to 10. We don't know the required return, which is the yield to maturity. The payment is equal to the coupon rate times the face value divided by the number of periods per year, so 90. Excuse me. The present value is a negative $1,134.20. And the future value is $1,000. So we want to solve for the interest rate or the yield to maturity. So clear your time value of money. N is 10. The payment is $90. The bond costs $1,134.20. It's a negative. And the face value is $1,000. So we compute the interest rate. And we get 7.08%. So the yield to maturity on this bond is 7.08%. So other things that we can calculate the current yield. That's the annual coupon divided by the current market price of the bond. The capital gains yield is equal to the change in price divided by the beginning price. And together, if you add these together, that makes yield to maturity. So the amount of money that you're going to make collectively, the yield to maturity, is equal to the current yield plus the capital gains yield. So we can calculate the current yield. For a 10-year, 9% coupon bond, today's price is $887, and the yield to maturity is 10.91%. So the current yield is equal to the annual coupon payment divided by the current price. So it's not the price that you paid for it, it's the current market price. So this is equal to, it's a 9% coupon bond with a face value of $1,000. And the current market price is $887. So to get the current coupon rate, the annual coupon rate, we multiply our coupon rate times the face value, divide that by 1 because it's an annual bond, and we divide all of this by the current market price of $887. So 90 over 887. And that gives you 10.15%. So we know that the yield to maturity is equal to the capital gains yield plus the current yield. So we can turn this equation around. We can subtract the current yield from both sides, and that gives us the capital gains yield is equal to the yield to maturity minus the current yield. If we subtract those, we see that the capital gains yield is 0.76%. Alternatively, you could also find the value of the bond in year 1 and year 2, take the difference, and divide by the value in year 1. So what if a bond pays interest more frequently than annually? So what if we have a semi-annual bond, one that pays interest every 6 months? You would simply multiply years by 2 to get the number of periods. So n would be equal to years times periods. So that would be, the periods here would be 2 if it's semi-annual. You would divide the nominal rate by 2 to get the periodic rate. So IY is equal to the required return divided by the number of periods. This is the generic form. If it's a semi-annual bond, the number of periods is 2. And again, to get the payment or the coupon payment, it's equal to coupon times face over periods per year. So it's the exact same thing that we've been doing. You take your coupon rate, multiply it by your face value, and you divide by 2 because it's semi-annual. You do not have to change your present value, and you do not have to change the future value. So we'll work an example. What's the value of a 10-year, 10% coupon semi-annual bond if the required return is 13%? So here, instead of receiving interest payments every year, we're going to receive interest payments every 6 months. So N is going to be equal to the number of years times the number of periods per year. And it's semi-annual, so that's 2. The interest rate is equal to the required return divided by the number of periods per year. So here that's 13% divided by 2 to get 6.5%. The payment is equal to the coupon rate times the face value divided by the number of periods per year. And so that's 50. The future value is still equal to the face value, and that's $1,000. And we can solve for the present value. So clear your time value of money. N is 20. The discount rate is 6.5%. The payment is 50. And the future value is 1,000. So let's compute the present value. And we get $834.72. This bond would cost $834.72. So it's fairly straightforward. Similar to doing the things that we did last chapter. In chapter 4, we looked at semi-annual. So what if a bond is callable? That means that the issuer can choose to repay the bonds early. So they make their required interest payments every period. And they choose to repay the face value of the bond at an earlier date. Generally, when they do this, they have to pay a call premium, which just means that they're having to pay more than the face value to be able to do this. So here we have a 10-year, 10% semi-annual bond with $1,000 par. It's currently selling for $1,135.90 and has an 8% yield to maturity. It can, however, be called after 5 years for $1,050. So the future value, or the face value would have to increase by $50. That would be the call premium for a company to enjoy this benefit. So we're asking, should you expect to earn the yield to maturity or the yield to call? So first we need to calculate the yield to call. So here, after 5 years, it can be called. This is a semi-annual bond. So N would be equal to 5 times 2 to give us 10. We're wanting to know the yield to call, so that would be the interest rate here, the IY. The current price of this bond, $1,135.90. When you put this in your calculator, you do need to make sure that you put a negative sign there. The payment, the coupon rate is 10%, so 10% times the par value, $1,000, divided by the number of periods per year, so that gives you 50. And the future value here is equal to the par value plus the call premium, so the $1,050. They're having to pay more than the par value to be able to call a bond. So first, clear your time value of money. N is equal to 10. The present value, $1,135.90, and that's a negative. The payment is 50, and the future value is 1,050. Because instead of the company having to make these interest payments for an entire 10-year period, they're only having to make it for 5 years. The investors have planned on this income stream, and so they must be compensated for these changes. So we compute the interest rate to give us the yield to call. So the yield to call was equal to 3.765. But remember, we have to multiply that by 2 because this is a semi-annual bond to give you 7.53%. So because the yield to call is less than the yield to maturity, the 7.53% is less than the 8%, we would expect to get the yield to call. We would expect the company to call the bond. That's because the company could repay these bonds early, then issue new bonds that would pay $75.30 a year in interest instead of the $100 a year that they're currently paying. So they would be able to issue new bonds with a lower coupon rate. So because yield to call is less than the yield to maturity, we expect to earn the yield to call. In general, if a bond is trading at a premium, then the coupon rate is higher than the current market rate, so a call is likely. So typically, you expect to earn the yield to call on premium bonds and the yield to maturity on par and discount bonds. Interest rate risk is the chance that interest rates will change, thereby changing the required return and the bond value. Rising rates will cause lower bond values. These are the greatest concern. The shorter the amount of time until a bond's maturity, the less responsive it is to its market value. Excuse me, I said that wrong. The shorter the amount of time until the maturity, the less responsive the market value is to a change in the required return. And that is depicted in that graph we looked at earlier, where all current market prices of bonds converge to their par value. Again, here's that same picture. So you see that the value, the current market value of a bond, approaches par. So the premium bond is going to decline in value while the discount bond is going to increase in value as maturity approaches. The real rate of interest is the rate that causes an equilibrium between the supply of savings and the demand for investment funds in a perfect world without inflation, where suppliers and demands of funds have no liquidity preferences and there is no risk. So in a perfect world where there are no problems. But the real rate of interest changes with economic conditions, tastes, and preferences. The nominal rate of interest is the actual rate of interest that's charged. So the rate of interest that the supplier of funds is charging and that the demander of funds is paying. The nominal rate and the real rate do not equal one another, and that's because of inflation and risk. So investors demand higher nominal rates if they anticipate inflation, and they demand higher nominal rates if there is any risk. So if there are any default risks or any contractual provisions. So the nominal rate is equal to this real rate of interest plus an inflation premium plus a risk premium. Let me fix this. So we don't know the real rate of interest, but we can approximate the real rate plus the inflation premium by the risk-free rate of return. So the rate of return on something like a U.S. Treasury bill, something that has very low default risk. So this risk-free rate embodies the real rate of interest plus the expected inflation premium. The inflation premium is driven by investor expectations about inflation. So the more inflation they expect, the higher the inflation premium, and therefore the higher the nominal rate of interest. So here's an example. Marilyn has $10 she can spend on candy. The candy costs $0.25 apiece. She could buy 40 pieces of candy today. It's the $10 divided by the quarter cost. So the nominal rate of interest is currently 7%, and inflation for the coming year is 4%. So if she invested $10, the $10 that she was going to spend today, how many pieces of candy could she buy in 1 year? So first we need to calculate how much money she'll have in 1 year. She would invest her $10 at a 7% return to give her $10.70. But the cost of candy would also increase due to inflation. So the candy now costs $0.25 apiece. Inflation is expected to be 4%. So in 1 year, the cost of candy is going to be 26 cents. So therefore, in 1 year, she could purchase $10.70 divided by a 26-cent cost, 41.2 pieces of candy in 1 year. So her increase in buying power is equal to the 41.2 minus 40 over 40 is 3%. That's her real rate of return. The term structure of interest rates is the relationship between the maturity and the rate of return for bonds of similar risk levels. We can depict this with a graphical representation called the yield curve. And this is what the yield curve looks like. So yield to maturity is plotted on the vertical axis and time to maturity on the horizontal. The position and the shape of the curve generally changes over time. A downward sloping yield curve occurs infrequently and is often a sign that the economy is weakening. Most recessions are preceded with a downward sloping yield curve. So that's also called an inverted yield curve, and it means that short-term rates are higher than long-term rates. So if you were to invest your money in a short-term CD, you would earn more than you would in a long-term CD. A flat yield curve means that interest rates don't vary very much. And a normal yield curve is upward sloping. this indicates that long-term interest rates are higher than short-term interest rates. And there are many different theories that explain this. The first is the expectations theory. This theory says that the yield curve reflects investor expectations about future interest rates. If investors expect interest rates to increase, then we would have an upward sloping yield curve. If investors expect interest rates to decline, we would have a downward sloping yield curve. So the expectations theory simply says the yield curve reflects investor expectations. If investors expect interest rates to rise in the future, then the 2-year rate today must be higher than the 1-year rate today, causing an upward sloping yield curve. So here's an example. We have an investor. He wants to invest his money for 10 years. So he purchased a 5-year note today, and he plans to reinvest that for another 5-year note in the future. So he's investing his money for a collectively of 10 years. And he is going to earn roughly 27.5%. So he's earning 3% a year for the first 5 years and 2.5% every year for the next 5 years. So for a 10-year bond to be competitive with 2 5-year bonds, it would need to pay 2.75% per year. So a bond that pays 2.75% for each of the next 10 years would give you the same return as 2 5-year notes. So therefore, because the 5-year rate is higher than the 10-year rate, the yield curve would be downward sloping. The second theory is liquidity preference theory. This says that long-term rates are higher than short-term rates because investors want liquidity. They perceive short-term investments to be more liquid, so they can get to their money quicker, and they perceive them to be less risky. So borrowers have to offer higher rates on long-term bonds to get the investors away from their preferred short-term securities. So all else equal, investors prefer to buy short-term securities, while issuers prefer to sell long-term securities. These short-term securities are attractive because they're very liquid and their prices are not volatile, so investors can access their money with much more ease. This theory only provides reasoning for the yield curve to be upward sloping. And finally is market segmentation theory. This theory just says that people shopping for a 3-month CD or a 3-month Treasury bill are not looking at different maturities. So they're not going to be looking at a 10-year investment. If they know that they only want to invest their money for a short period of time, there's no reason for them to even look at longer maturity securities. So everything is determined by supply and demand within the maturity segment. So those looking for short-term securities, the supply and demand of those would determine the market rate, while those looking for long-term securities, the supply and demand of those wanting the longer-term securities and those supplying them are going to determine those market rates. So they don't really impact one another. So the slope of the yield curve would be determined by the prevailing rates in each market segment. So if it could provide evidence for the yield curve to take any direction imaginable. So an upward sloping yield curve in this instance would indicate greater borrowing demand relative to the supply in the long-term segment relative to the short-term segment. So the determinants of market interest rates. The required return is equal to the real risk-free rate plus this inflation premium plus our risk measures. And for our risk measures, we use the default risk premium, the liquidity premium, and the maturity risk premium. So the inflation premium is the average expected inflation rate over the life of the security. The default risk premium reflects the possibility that the issuer will not pay the interest or principal at the stated time in the stated amount. The liquidity premium is the premium charged by lenders to reflect the fact that some securities cannot be converted to cash on short notice at a reasonable price, so it's not heavily traded. And the market risk premium, longer-term bonds are exposed to significant risk if price declines, so lenders charge an amount to cover themselves from this risk. So what is the nominal risk-free rate? Treasury inflation-protected securities are tied to inflation and are a good estimate of the real risk-free rate. So these incorporate the inflation premium on these. So that would cause our equation for the required return on a debt security to be equal to the risk-free rate, this rate on Treasury inflation-protected securities, plus our measures of risk, the default risk premium, the liquidity premium, and the maturity risk premium. The default risk premium is the likelihood of default. The greater the default, the greater the yield to maturity, so therefore the lower the market price today. You must be compensated for bearing this additional risk, whether the company might not pay the full amount of the bond. So there are different factors that affect the default risk premium. We can look at a company's financial ratios. We can look at contractual provisions. So is this secured or unsecured? Is it senior or subordinated? By that I mean if it's senior, the company must repay this debt first ahead of other debts before they go out of business. If it's subordinated, it would rank below other forms of debt. We could look at their earning stability, the regulatory environment, potential product liability. There are many things that go into determining whether a company has a high chance of default or not. And we can also use bond ratings. So the higher the rate of the bond, so the investment grade bonds have a much lower chance of default than junk bonds. And you can see this with the bond spreads, the difference between the bond's yield and a treasury security of the same maturity. So the spread on an investment grade bond is much smaller than the spread on a junk bond. So you're going to receive more in terms of a yield with a junk bond rather than an investment grade bond because you're having to be compensated for the chance that the company will default. The liquidity premium. Investors include liquidity premiums when market rates of security are established. Any company whose securities are more difficult to convert to cash would have a higher liquidity premium. So if you are investing in a company that is thinly traded, so there aren't many trades that take place per day, it may be difficult to sell your bond. So you could look at this as corporate bonds by unheard of small companies versus those by large, well-known companies. It's obviously going to be more difficult to liquidate bonds that in a small, unheard of company than those of large, well-known companies. And the maturity risk premium. This is the risk that the bond values will decline due to rising interest rates. Interest rate risk is higher for bonds with long maturities. So the longer the maturity of the bond, the more responsive is its price to changes in interest rates. Reinvestment rate risk is the risk of an income decline due to a drop in interest rates. So can you reinvest your money at the same rate? Let's suppose you won $500,000 playing the lottery. You invest the money and live off the rest. So you buy a 1-year bond with a yield to maturity of 10%. So your year one income would be $50,000. That would be the interest earned on the money that you are depositing. At the end of the year, you would still have the $500,000 that you would invest for the second year. Again, we'd be living off the interest, but your income would drop because market rates have dropped. So if the market rate has dropped to 3%, your income for the year would drop from $50,000 to $15,000. So had you bought a 30-year bond, your income would have remained constant. So investment interest rate risk refers to the value of the bond, while reinvestment rate risk relates to the income the portfolio produces. If you hold long-term bonds, you will face a lot of interest rate risk because the value of your bond will decline if interest rates rise, but you will face little reinvestment risk. If you hold short-term bonds, you face reinvestment risk but little interest rate risk. So here, this is the same picture we looked at earlier, the interest rate versus yield to maturity. This is describing the relationship between long-term and short-term rates. So here we're looking at the yield curve again. Typically, long-term rates are higher than short-term rates because of this maturity risk premium. So you can see how each of the risk components comes together to cause yield curves to change. The final topic within this chapter is bankruptcy. There are two main chapters that we're going to look at, as Chapter 11 and Chapter 7 bankruptcy. So Chapter 11 bankruptcy is simply reorganization, while Chapter 7 bankruptcy requires liquidation. Usually a company wants Chapter 11, but some creditors may prefer Chapter 7 so that they can get some of their income, some of their money back. If a company can't pay what it owes, it's going to file under Chapter 11 bankruptcy, which is reorganization. That's going to keep creditors from foreclosing and taking their assets and shutting down the business. At this point, a company has 120 days to file a reorganization plan. The court's going to appoint a trustee to supervise the reorganization, and management usually stays in control. If the company can demonstrate that it's worth more alive than dead, then they will be awarded Chapter 11 bankruptcy reorganization. Otherwise, the judge will order liquidation under Chapter 7. So if a judge requires Chapter 7 bankruptcy, this is the payment priority. First, they will have to pay past due property taxes. Then they will have to pay secured creditors. Then the trustee's costs. Then the bankruptcy expenses. Then wages and unpaid benefit contributions, unsecured customer deposits, taxes, unfunded pensions, unsecured creditors, preferred stock, and finally common stock. In liquidation, unsecured creditors usually get nothing. So it makes them willing to participate in reorganization, even though they won't get what they're owed. So they're going to get a significant amount less than what they're actually owed. Various groups of creditors vote together on the reorganization plan. If the majority of the creditors and the judge approve, the company will emerge from bankruptcy with lower debts, reduced interest, and a chance for success. That's it for Chapter 5.